Good morning, good day, and good afternoon. My name is Mike Acton. I'm the head of research for AEW Capital Management in North America, and I'm here today to talk about the rise of alternative property sectors in the U.S. commercial real estate space. What is considered core property investment by U.S. institutional investors is changing rapidly. In fact, it's already changed rapidly in the U.S. listed real estate sector, the REIT sector. The chart on the left-hand side has a thick white line going from left to right. It starts at about 85% about 10 years ago and declines to about 50%. That's the share of the U.S. listed market that you would think of as traditional core property sectors. In other words, office, apartment, industrial, and retail. 10 years ago, 85% of the market. Today, only about half of the market. Well, what's taken its place? Well, what's taken its place is a whole host of new and emerging property sectors, things like data centers and self-storage and student housing and life science. Many new property sectors that really weren't on many investors' radar screen just a handful of years ago. On the right-hand side, I'm showing you the U.S. core open-ended fund private equity real estate market and other big core funds that institutional investors allocate capital to. 10 years ago, 2% of all property in that space was considered other. In other words, not those four major property types. Today, that's grown up to 5%, may even be a little bit higher. We may be understating it a bit in the data here, but it's growing quickly. Just to give you an example of investor acceptance of alternative property sectors, when I joined AEW back in 1990, institutional investors in the U.S. largely would not even consider investing in apartment buildings. The lines on here are showing you the share of properties and the share of capital value in the NCREIF property index, the large institutional investment universe of properties. Back in 1990, it was almost zero. When we would talk to institutional investors back then, they would cite things like headline risk. Oh, I don't want to show up on the 6 o'clock news evicting people. Or they'd have concerns about operating intensity. Oh, we have to have a lot of people at the property to make sure it runs correctly and so on. Well, institutional investors got over that reluctance for apartment investing, and today it's about 25% of their portfolios, and in most cases it's their most favored property type in their portfolio. Clearly there's a lot of different types of alternative sectors, and the list is growing every day. All of them collectively have some considerations that may be in common. In many cases, an alternative property sector could be thought of as a subset of a larger property sector. Take office property, for example. Office property today, the outlook is very uncertain. Don't really know when tenants are going to come back, how many people are going to be remote, how many aren't. But there are subsectors in there where you can have more certainty and more predictability about demand. Medical office property, life science properties. But keep in mind, that tenant base is a narrower tenant base. It is a subset of the larger one. So you're narrowing your demand down. At the same time, in many cases, you're going to be looking at a property type where there may be larger capital investment needs by the owner, greater fit out, more specialized fit out for the tenant, and there may be more operational intensity. Some parts of storage where you may have to provide services, some parts of housing like senior housing where you may have to provide some more services, more operational intensity. But at the same time, you're getting a tenant that is likely going to stay longer. They like that capital you're putting into the property. They need it for their business. They're not going to leave as easily at the end of their lease because they need to find another property that has similar capital investment. And they're likely to be fine with paying a higher rent. You're putting capital into that property and you're essentially capitalizing it into a higher rent value. So all of those things can add up to a much more stable, predictable, and higher income stream for the alternative property sector relative to the broader, more traditional property sector. I'd just like to highlight a few of these sectors in what may be some factors or thematic aspects that provide tailwind to investing in these sectors. The first one up here is senior housing investment. We've been investing in seniors housing since the mid-90s, and we are one of the larger senior housing investors in the U.S. today. The demographic story for senior housing is incredibly strong. The United States had a large baby boom after World War II, basically from about 1946 to 1964. Those people have aged, and the oldest of them, I'm right at the tail end, the oldest of them are in their mid-70s, and the youngest are just inching up on 60. Over the next 10 to 15 years, this group of people is going to be aging into that period of their life where they're going to be looking for more assistance in their daily living, the activities of daily living, and their housing solutions. It's a demographic wave coming for seniors housing. At the same time, as birth rates have fallen steadily since the baby boom, there are fewer and fewer adult children per older baby boomer. They need these adult children to help them with these daily activities, help them make decisions about their housing solutions, and so on. And increasingly, they're going to be looking for more, the boomers are going to be looking for more and more professional assistance in their future housing needs. Another property sector I'd like to highlight is cold storage, refrigerated warehouse. There was a pretty clear change in consumer preference that happened over the past 10 years before the pandemic, where many U.S. consumers were expressing stronger demand for fresh food as opposed to frozen or processed food. I think that makes sense, healthier food in general. During COVID, a lot of American consumers got really comfortable with the idea of buying grocery items, food in particular, online, something most households had largely never done before the pandemic. So what I'm showing you on this chart here by product category from grocery stores is how much did that preference or tolerance for buying items online increase during the pandemic, and how has it changed since the peak of the pandemic? And I've highlighted a few categories on here that really need to be temperature controlled. Fresh fruits and vegetables, fresh meats, and deli meats. And the preference for those, buying them online, has gone up a lot during the COVID period and has not backed off. This is a permanent change in consumer preference in the US. More fresh foods and more comfortable getting them through an online distribution channel. All of that adds up to cold storage warehouse. On the right-hand side is some more interesting data on changes in US eating behavior. Prior to the pandemic, the amount of dollars spent on food at home, in other words, grocery stores, and food away from home, in other words, restaurants, was just about the same. And in fact, 2019 was the first year in US history where Americans spent slightly more money on food away from home than food at home. Well, the pandemic, of course, upended all of that. The amount of dollars being spent on food at home soared, the amount of money being spent on food away from home plunged, and then they came back towards each other. But there is now a sustainable gap between money spent on food for at home versus away from home, and that gap is not narrowing. Take that along with the higher consumer acceptance of online shopping for grocery, and again, that creates great tailwinds for refrigerated warehouse, what we call cold storage. Let's take a quick look at medical office property. Again, as I said before, a subset of office property, generally speaking. When we look at the data, we see several things, of course. Americans are getting older. Older people spend more money and more time on doctor's visits, on medical procedures, medical services, and so on. So what we're showing you here is visits to physician's office by age. Goes up steadily, of course, as you get older. I think we all understand that. Per capita medical expenditures by age goes up as you get older. I think we all get that. What else is going on here is that the healthcare providers themselves are trying to move the provision of services from center city, downtown locations that are very capital intensive, huge complexes of medical properties in cities. They're trying to move those out to where these older patients live. Many older people don't want to get in a car and drive to a downtown location in a city to get medical services. They want the brand name, they want it near them, and that's what the service providers are doing. And the data on the right-hand side is showing you the change in inpatient versus outpatient patient visits. And it's a very clear trend. Hospitals and service providers are trying to make more and more medical services be provided on an outpatient basis as opposed to an inpatient basis. It's cheaper for them, it's cheaper for the whole system, and it's cheaper for the customer as well. And then finally, the lab space, lab and life science. Again, it's a subset of office property. Office property, broadly speaking, has a lot of uncertainty. But lab space and life science property simply does not. The activities that go on in life science buildings cannot be done on a work-from-home basis for the most part. You're not taking your science experiment, your advanced medical research, you're not taking that home with you and doing it in the spare bedroom or the basement. It has to be done most of the time in a climate-controlled environment with strict guidelines, strict safety protocols, and so on. Today in the United States, the vacancy rate for life science properties is basically zero. And that's true across all of the large life science centers in the United States, those centers being Boston and San Francisco and San Diego and New York, and there's a handful of others. But the point being that the demand for this space is very, very strong. It does not have an alternative that can be easily adopted. And the demand is not only growing fast, it's going to continue to grow fast. And we can look at simple things like private equity venture capital going into the life science space. It correlates extremely well with future demand growth for the space itself. With so many different choices to look at today, especially compared to maybe even just 10 years ago, of course there's a variety of outcomes and places in the cycle where each of these property sectors sits today. Some, the revenues have likely already peaked and growth is slowing. Some, that revenue has hit its bottom and is likely coming back up. At the bottom end, clearly regional malls, some parts of the office sector had a very tough experience during the pandemic. We think that's largely bottomed out and starting to pick back up. Again, a lot of uncertainty as to how quickly that picks up. Other sectors like data centers and self-storage, revenue growth for this cycle has probably already peaked and will be slowing. Every other sector is somewhere in the middle, and each one of these is a story and a set of facts to investigate as you get more comfortable thinking about investing in them. So where to look for good investment opportunities today? There's a lot of ways to settle that question. This is a very simple example here. I'm looking at initial yields, the current cap rate on the bottom axis versus the expected NOI growth on the vertical axis. I think the intersection of those two things tells us a lot about where the best risk-adjusted opportunities might lie, and I've circled them here for you. Really, anything related to housing in the United States today should be of interest to you. The United States housing market is one of the largest and most liquid asset markets in the whole world. It's estimated to be roughly $40 trillion in total size. But we have a serious problem in the United States. We have a real problem with affordability, whether that's for sale house or for rent housing. Both segments of those markets have affordability problems, and there's many, many opportunities to provide new solutions in housing today for American families, American households. Also in that circle, you'll see life sciences, you'll see self-storage, you'll see industrial, you'll see manufactured homes. Again, each one of these has a story about where it is in its cycle. Self-storage may be getting a little bit late in the cycle. There could still be opportunity. Industrial has been incredibly strong. Last year, the average industrial property in the United States increased in value by 40%. And the average industrial rent today is more than 40% higher than it was 5 years ago. So if you own one of these properties, those leases are going to roll up to a new, much higher rent every year going forward. So again, each of these sectors has a unique story. We'd be happy to work with you on exploring any of those. All right, so just in conclusion, the alternative property sectors in the United States today represent about half of the market cap of the listed real estate market, but a much, much smaller percentage of the private direct market. That's going to change, and it's going to change really quickly over the next few years. The private market is going to catch up to the public market. It has in many other dimensions repeatedly throughout history, and on this particular dimension, I think it will again. Private market was very slow to adopt these. Acceptance is growing. I showed you the example of apartment properties in the US back in the early 90s when institutions simply did not want to invest in them. We heard that again around 2000 for senior housing investment, and we hear it today for things like essential housing, housing that's appealing to the moderate to lower income household. Concerns, of course, will persist for ideas like liquidity and performance through an entire cycle. I think those can be answered for you, the questions you might have there. The liquidity is growing quickly, and so far, the cash flow characteristics of these alternative sectors have proven quite resilient and quite attractive for institutional investors. COVID accelerated a lot of changes that were already occurring, and this adoption of alternative property sectors is a really good example of that acceleration of a trend that was already in place. 10 years ago, core property meant a very specific thing to most investors. It meant investing in 4 major property types, largely in coastal gateway cities, very big, deep, liquid markets. That was what core was. Increasingly, the definition of core property in the United States is becoming not so much identified by physical characteristics or location characteristics. It's increasingly being identified by the characteristics of the cash flows these properties generate. If they can generate durable and sustainable cash flow over an entire cycle, those cash flows are increasingly being thought of as core. And that's where institutional capital is migrating, and I think it's going to accelerate from here on. Thank you for having me today. Look forward to your questions.